Well, why don't I kick it off? Thank you, everyone, for joining today. We are going to be talking about 3iQ introducing Ethereum staking in the regulated market. So excited for everyone here to be joining. It's myself, Christopher Matta, joined with Connor Loewen and Andrew Ballinger. We'll introduce ourselves shortly. But first, as always, we have to highlight our disclosures. If you need to read a little more in depth here, you can go to 3iq.io/content-disclosures. Of course, everything we share on here is not investment advice. And with that, we can go on to the agenda. So today, when we were talking about Ether and staking, we're going to go through a bunch of different components. First, we'll be starting with what is Ether and staking at a high level. Going through 3iQ's roadmap and history of innovation with regulators and regulated vehicles, and then talking about some of the challenges associated with staking specifically and the benefits of staking in a fund structure, which is what 3iQ recently announced. So, and then we'll have an open Q&A. Everyone can drop questions in the Q&A section of the webinar. Feel free to drop questions throughout the webinar, but we'll likely save them to the end to go through them. If I do see questions coming in, though, in the middle of a slide, maybe we'll try and address them real time. And then from an intro standpoint, if you just want to go to the next slide, Connor. Hi, everyone. I'm Chris Matta. I am the President and Chief Strategy Officer at 3iQ. I'm based in the US. I've been at 3iQ for about 3 years, helping grow our global footprint. I've been an entrepreneur in the crypto space since 2017 and helped launch one of the first investable crypto indices back when that was just kind of becoming a thing. Now we're almost to ETFs in every major jurisdiction around the world. So very exciting. And I started my career in traditional finance at Goldman Sachs. I'll pass it over to Connor to introduce himself, and then to Andrew.
Hi, everyone. My name is Connor Loewen. I'm a cryptocurrency analyst for 3iQ. I've been here for quite a while. I even recognize a few faces in the webinar, so hello again. I've been at 3iQ for over 6 years, pretty much since the founding of the company. I lead research with my head of research, Mark Connors. We study protocols all day long. Ethereum in particular is particularly interesting, so I can't wait to show you some more about what we've found. I'll pass it over to Andrew.
Hi, everyone. I'm Andrew Ballinger. I'm a manager of product and partnerships here at 3iQ, where I focus mainly on staking as well as our institutional business. I came from a venture capital firm where I focused on running a staking program for our illiquid venture investments. And prior to that, I was one of the first blockchain researchers at the World Economic Forum. So pleasure to have you all.
Great. Let's dive into it. So for those that may not know a ton about 3iQ, we are one of the oldest and largest digital asset managers launching regulated products on a global scale. To just go through the timeline, 3iQ was founded back in 2012, initially a multi-strategy hedge fund shop. But as crypto grew in 2015, 2016, the firm pivoted towards being a dedicated crypto firm. And starting in 2016, and this is 3iQ's biggest claim to fame, in 2016, 3iQ filed for the first Bitcoin ETP, regulated ETP in North America. And that process took 3 years of engaging with the regulators, the OSC, the Ontario Securities Commission, and other regulators, other provincial regulators in Canada, to educate and develop the product and the infrastructure to bring the first Bitcoin ETP to market. And that took 3 years. And in 2019, we got the groundbreaking decision and green light to be able to launch that first Bitcoin ETP. And we followed that up successfully in 2020 with the first Ether exchange traded product as well. Both of those listed on the Toronto Stock Exchange. And so over the past several years, 3iQ has really been focused on working with regulators to launch easy to access vehicles for the crypto ecosystem, packaging up all the different complexities of the space, from custody and trading and tax reporting, to make it really easy to access Bitcoin, Ether, and crypto assets in traditional brokerage accounts. And so most recently in 2023, just a couple months ago, we announced that we are planning to implement staking into our Ether exchange traded products, our Ether closed-end fund, the Ether fund, and our Ether ETF. And that's groundbreaking because it is the first staking ETPs in North America and the first staking ETF globally. So we'll talk a lot more about that as we get into some of these slides, but that's a little bit of background about 3iQ.
So I'll be handling these. So this is what is Ethereum and staking, really, from a high level. So we're taking a look at Ethereum here. It is the second largest cryptocurrency globally if you look at its protocol native token, Ether. So it's around a $200 billion market cap as it stands now. But unlike Bitcoin, which was predominantly designed for payments, Ethereum is more designed as a decentralized computer for any type of application. And it's also increasingly becoming the blockchain of choice for enterprises. So just several of the organizations that we've seen started to develop on Ethereum, I mean, spans from investment banks and large global banks to large tech companies, to even hardware manufacturers like Samsung.
To Connor's point here, if Bitcoin is really digital gold, Ethereum is digital oil. It's the infrastructure underpinning most of the industry and the activity on top of it. There are a lot of use cases that are common that I'm sure a lot of people in the crowd have heard about. The most popular being transparency and trackability of supply chains. Looking at Anheuser-Busch here at the top, Anheuser-Busch launched a pilot in 2020 to track barley across their supply chain, and even consumers could scan a barcode and see where the barley and which farm the barley was sourced from in each individual can. So I know those use cases may not seem unfamiliar, but really Ethereum was the innovation that enabled all of this to exist today. So I wanted to highlight that.
Absolutely. When we take a look at Ethereum staking in particular, especially with this presentation, really at a high level, what is staking? It is strengthening the security of the network. You are participating in the consensus mechanism. It's very similar to as if we were Bitcoin mining. Participating in mining helps secure the Bitcoin network. The same way goes that staking helps secure the Ethereum network. So as a little history, back in 2022, I'm sure a few of you are familiar, there was the merge. Essentially what had happened was previously Ethereum was like Bitcoin, where you had to run very specialized computers. In this case, it was graphics processing units, or GPUs, manufactured by NVIDIA and AMD. I'm sure you've heard those companies. You would use computer hardware to manually hash out the algorithms in the network. And essentially what we've done now is we've changed away from a proof of work consensus mechanism to proof of stake. So what is staking? Well, rather than running computer hardware that's just running scripts all day, you're similarly running scripts, but you're doing it in like a different architecture. And what you're doing is you're staking your ETH, therefore ETH in cold storage or even hot storage, whatever it is, just ETH. ETH gets moved into what we call a validator node. So a validator node is a very fancy way of saying it's basically just an executable file that you run on your computer. It's like the Ethereum software, and you move your 32 ETH into that software. And then once you do that, you essentially activate the validator and it can start making rewards on the network. However, before making rewards, typically validators will be chosen by like a sort of algorithm. And what happens then is if the validator is chosen to propose these transactions in the block, they will receive rewards for doing so. So there's two different reward streams with Ethereum. There's the consensus layer rewards and the execution layer rewards. So we can talk a little bit more about that later on, but I wanted to dive more into the network overview.
One thing on the last thought I also just wanted to highlight for everyone, and why this is so important now, is Connor mentioned it at the beginning, is really that change in consensus mechanism where Ether previously was proof of work like Bitcoin. And the reason why we're focused on implementing staking into regulated vehicles today is because of that transition that took place starting last year, and it completed earlier this year, really only making staking a more liquid consensus mechanism. Prior to that, it was not really viable for a regulated vehicle. So that was a fundamental change that now allows us to be able to bring things like staking to investors more widely, and you're going to see a lot more staking solutions and products permeating throughout the market over the next couple of years as the industry gets more mature.
Chris, that's a good point. Like, traditional fund managers like us, if it was Bitcoin, there was no way for us to use our Bitcoin in the fund to be able to participate in the consensus of the blockchain to make rewards. Because if we were doing that in Bitcoin, we would literally need to buy computers, ASIC miners, and be running like a Bitcoin mining operation. Whereas with Ethereum, with proof of stake now, it was almost like with the flip of a switch. It seems like anybody holding ETH can now participate in the consensus and help make the network stronger. So yeah, that is a good point. It was all because of the merge. And specifically for us as fund managers, I'll talk a bit about it later on, but Shapella, the upgrade Shapella, was actually the really key critical update that we needed as fund managers to be able to go ahead with this project.
Yeah, and I think you hit on a good point there too, Connor. Securing, like staking Ether is securing the network. So for holders of Ether, there is some technical challenges, and Andrew will walk through some of that detail later. But if you are finding a way to stake that Ether, you are contributing to the security of the network. So for participants in the network, that's a key variable and key factor to being an active participant in the network.
I agree. When we take a look at just the total number of validators or the total number of active validators, for example, you can see that there was no way to stake before what we call the beacon chain launched, which was essentially another blockchain that was running concurrently in perpetuity with the Ethereum network for a while. And what they were doing is before the merge event, they basically were letting this network run and they were debugging it. They were basically testing it, making sure that it worked, that everything was sound and ready to be deployed on what we call the Ethereum mainnet, or the Ethereum network as we know it today. So when you take a look at this, the beacon chain launched quickly. We surpassed about 250,000 validators. It actually wasn't until the Shapella upgrade that validators could actually leave the network. And that was the point I had made earlier. As fund managers, we have to be able to facilitate redemptions out of vehicles, for example. So if we were staking ETH, how can we take the ETH out of a validator without the ability to withdraw the assets? So Shapella was a core upgrade for the network that enabled, I think, a lot of institutions like us to be able to offer staking products to clients. As you can see with the Shapella upgrade, the reason why I bring this up and I annotated the chart is you can tell the total active validators actually declined right out of Shapella. And that was due to some restructuring. There was, I believe, some US related entities that had some regulatory oversight and regulatory actions against them that made them change their staking setups for customers. So you can see right out of the gates, there was some validators had left the network, but then it quickly came up again. So now I believe the numbers are actually up above 750,000. I think we're around 800,000 validators now. But the real interesting chart that I like to think about is the inflation rate versus what we're valuing this stuff in, right? And we think about the price of ETH in dollars, or we think about the price of ETH in gold terms, or whatever it is. Well, interestingly enough, with blockchain technology, you can see and calculate the inflation rate on a per block basis for any network, for Bitcoin or ETH. So I have a chart over here of the ETH inflation rate versus the US and Canada inflation rates. And one thing I wanted to point out is that generally with every upgrade to the network, we'll call them, proper word for it is soft or a hard fork, but with every upgrade, the monetary policy could change with Ethereum. But what we've seen is that pretty much since its inception, ETH has been a disinflationary asset, meaning it does inflate, but at a lesser amount as time goes on. Once the merge happened and we combined into a proof of stake consensus mechanism, it allowed the network to actually get to a state which I call like a deflationary state. So it is not disinflationary anymore. It is actually deflating. So the circulating supply is being destroyed out of circulation. So for anybody here that's familiar with concepts of microeconomics, like the law of supply and demand, if demand stays the same or increases and supply is decreasing, the price goes up. So again, I think there's some very creative strategies that the Ethereum Foundation, all the Ethereum participants, everybody else have put so much time and effort into making the monetary policy sound. And I think they have, because as we can see with the participation of staking on the next slide, you'll see that it's pretty much straight up out of the gate. So as you can see now, The dark blue area graph here is the percent of supply staked. So how much ETH is out there and how much is staked. We're around 20% right now. The circulating supply of ETH is sitting on this light blue line. So this is about 120 million coins. And you can see I annotated a few sections over here, just highlighting the different events that had gone and happened in that time period to get where we are today. So around 120 million ETH outstanding with about 20% of the network staked.
This is a really interesting graph to me as well, and one that I've seen other people point to. But as you know, in this period of market activity, we've seen both price and adoption taper out, just given the cycle we're in. But surprisingly, staking activity and user staking has increased throughout that, showing that it's one of the areas within this industry that still managed to grow.
That's well said.
Yeah, we've seen that during prior cycles too. So this is not anything new. During other crypto bear cycles, while there wasn't price appreciation, infrastructure development, things like, funny enough, in the prior cycle in like 2018, 2019's bear market, the whole lending infrastructure didn't exist. And that was really something that became a lot more robust during that period. Similarly here, the staking infrastructure has really been accelerating. There's a lot of different staking solutions and offerings that have come to market, and we anticipate that to continue throughout the rest of this cycle.
Right, I think this one's going back to you, Chris.
Yeah. So highlighting the regulatory roadmap that we've been on for the last several years. So I mentioned during the intro that 3iQ has this history and this track record of really setting regulatory precedent, going all the way back to really 2016 when we first filed, and then 2019 when we finally got approved for the first Bitcoin, and then Ether in 2020, the first Bitcoin and Ether ETPs. And that's really where 3iQ's bread and butter has been. And so on the staking side, we followed a very similar approach. As staking has been developing, Connor walked you through some of those key protocol changes over the past several years, the merge and then the Shapella upgrade, which have really brought us to today, where staking is more liquid and more feasible in regulated vehicles. Throughout that whole process, we've been engaging with regulators, really from an education standpoint, to both help educate them on how staking works, and then also to really find ways to integrate staking into regulated vehicles. And so we've seen recently, the Canadian Securities Administrators, the CSA, actually published guidance in this past July around staking in regulated asset management vehicles. And that's directly off of kind of the conversations and the education and the interactions that we've had with the regulators over the past, several months and years. And some of the things that they're contemplating in these regulated vehicles are things like liquidity risk. We talked about how before the Shapella upgrade, it wasn't possible to unbond or unstake Ether. Then now they're looking at what are those unbonding periods? How does that impact potential investors? Additionally, things like valuation methodology, what the risk disclosures are going to look like, making sure that the asset managers are performing the proper due diligence, that there's the appropriate segregated custody and validators, and we'll talk through some more of these things. But these are all the types of perspectives that the regulators are contemplating when thinking about how to integrate staking into regulated vehicles and ensuring that the appropriate consumer protections are in place. And so we've continued to be at the forefront of that, working with the regulators, and hopefully bringing those products to market in the coming weeks here. Yeah.
So we've touched a bit on how staking technically works, but there are a lot of business considerations when actually amending a program like this. Liquidity, the first one, is something that's been brought up a few times already. But even after the Shapella upgrade, where ETH has become liquid and available to withdraw from staking validators, there's actually still a 2-day lockup period inherent to the Ethereum network that you have to consider when staking assets. There's also a variable exit queue based on network activity, but a few different services have arisen to provide liquidity for the ETH network and for staked assets. There are sacrifices you'll have to make when considering those programs, but I thought it'd be worth of note, especially since we're going to get into how we think about this in a registered fund down the line. Moving on to custody, some staking programs may require holding assets in warm wallets. Those would be wallets that are connected to the internet and potentially subject to hacking or other risks. The best practice here is staking from cold custody, wallets that are not connected to the internet and are sitting with a qualified custodian to limit both counterparty and hacking risk. With any new technology, regulations often take time to catch up, and the staking industry is no different. We've seen regulators in our process, and we've seen even the public conflate staking programs to lending programs or dividends with stocks. But in reality, these staking is a programmatic activity, and stakers play a role in securing the network, which makes I think lending and dividends not a true equivalent. KYC and location of validators are also really key considerations when thinking about compliance with staking, and all things that we've had to think through, and something that anyone staking assets should look into. Unfortunately, there's not a lot of transparency into that if you're doing it yourself, but really there are third-party service providers that can come up and assist with that, and I'll get into that a little bit later. Oversight is key here. Staked assets and the yield generated, you have to constantly restake those assets, as well as diligence any provider you use. And Connor, I know you have great insight into diligencing counterparties, if you want to touch on that.
Yeah, particularly with vendor selection. I mean, from myself as an Ethereum network participant, and I have friends, I have other colleagues that I know. A lot of people opt to use services which maximize yield, or do this and this and this, or they offer liquidity advantages like their liquid staking token. I think ultimately what it comes down to is every possible vendor will have its own set of risks. And I think when it comes to staking, which is already a novel technology, and most people aren't super familiar with, the cryptographic implementation of all of this, even if it's implemented on a smart contract, for example, most of these liquid staking tokens are implemented on smart contracts. A lot of the participants who are using these smart contracts are not qualified or have not conducted due diligence or done an audit on the contracts that they're interacting with. So when it comes to Ethereum staking in vehicles like ours, where we're talking about hundreds of millions or billions of dollars worth of assets, there needs to be extensive due diligence done on these vendors.
Yeah, absolutely agreed. And lastly here, high barriers to entry. To stake your own assets and run your own validators, you need 32 ETH, a significant amount of money, and technical knowledge to do so. You also have to run a server on AWS or another provider. But if you go with a service provider too, doing things like best practice around custody, storing your assets in cold custody, require an even higher minimum to make efficient economically. So finding the right program for you, unless you decide to do it yourself, all come with considerations and various trade-offs. I think we'll move over to the next slide, which is, in practice, what are the options here? So, as we discussed today, ETF staking or even in a public fund don't exist today in North America, but would allow, Canadians and purchasers to buy directly within their brokerage account. And the idea being, holding a staked fund in your brokerage account would potentially offset the costs of management fees, as well as generate some yield to end holders. Staking as a service is an option that I touched on earlier. And taking a step back, the ultimate goal of any program is to maximize yield while minimizing any risk of staking and counterparties and hacking. Staking as a service, you give up some of that exposure and you take on some counterparty risk, but really you give up a lot of the technical responsibilities of staking too. Exchange staking is done directly on an exchange. Similar to staking as a service, you take on a little bit of counterparty risk. Holding on assets on exchange is never best practice. If you can afford to hold assets in cold storage yourself. Decentralized staking services are held directly on chain, so in warm walls, like I mentioned earlier. And then running an independent staking node is, spinning up your own validator. You have 32 ETH and managing all the technical implications of it yourself. We've touched on some of these safety considerations already, but a best practice in the industry is to, instead of sitting alongside others or commingling assets in a pooled staking program, sometimes you'd see that in decentralized staking or chain staking. Spinning up your own dedicated validator where the validators only oversee and delegate your staked assets is absolutely a best practice. Cold storage too, like I mentioned earlier. And then, we'll get into this topic lightly, but slashing guarantees. There are some technical risks with staking if, the third party that you're validating to is not operating those networks properly, or, undergoes downtime or makes some mistake. And so having some, formal recourse in those situations is absolutely best practice as well. And that touches on diligence too, which Connor mentioned. You have to understand the business risks of the counterparty as well as the technical risks of whatever smart contract they're operating on. And so, as you can see, staking is absolutely a complex thing, but something that if you're an expert in, is incredibly valuable.
And now I'm going to talk through some of the benefits of staking in a fund structure, and then a little bit more specifically about what we're doing here at 3IQ to make this available. Before I do say that, I do have to just give another disclaimer. So we did announce the intention to enable our Ether staking funds with, or our Ether funds with staking. We announced that back in June. And we're hopeful that that is going to be going live in the next few weeks. We're finalizing certain things with the regulators and certain legal requirements and disclosures that we need to make. So we'll be able to share some more detail, more specific detail about the product structures once those approvals have come through. But I'll talk through at a high level some of the benefits and then how we're intending for some of this to look on the next couple of slides. So I guess starting here, just at a high level of, really the benefits of staking in a fund structure, as Andrew highlighted through the variety of different ways that you can go about staking, from setting up a validator yourself with 32 Ether increments, or, using another staking as a service platform. There are risks and hurdles and technical complexities to all of these different solutions. So one of the benefits of doing this in a regulated fund structure is that it's simple. You can purchase the fund in your brokerage account and automatically start getting access to some staking yield benefits. Where you have a professional manager like a 3IQ, an asset manager that is regulated, following certain compliance protocols, operational procedures, doing diligence to manage and maintain those validators, or through a partnership with other validators on your behalf. And that really just simplifies the custody component, the actual technical staking component, any sort of tax reporting, and allows you to access Ether and staked rewards through a traditional brokerage account or a tax advantaged account. Secondly, is the security of it. Again, as we talked about, complexity around setting up some of this, the potential risk around things like slashing, or technical inexpertise, or the counterparty risk of working with a more retail platform that may be more lightly regulated. We've seen a lot of regulatory actions against staking as a service providers in different jurisdictions, unfortunately. But 3IQ, we're working with segregated cold storage infrastructure from a custody standpoint, which means assets are segregated in the name of the fund, and the fund is a segregated legal entity that holds the assets on behalf of all of the unit holders. And then in addition to the custody component, which is with our partner Coinbase, Coinbase is obviously the largest, most financially healthy crypto custodian probably in the world, and most highly regulated. And we are working with them to have dedicated validators using their institutional staking infrastructure, dedicated validators to have the Ether for the fund staked on behalf of the fund. And that means that those assets are not being commingled with any other assets, which is something that's gone many staking platforms, some of the other solutions like staking as a service solutions in hot water with the regulators has been like commingling kind of those assets. So we're working really through an institutional infrastructure, keeping those assets segregated in cold storage. They remain in cold storage even while being staked through dedicated validators with our partners over at Coinbase. And then lastly, again, we are focused on working with the regulators to make this available to investors, providing the appropriate risk disclosures around how this is going to work, and ultimately increase returns for investors while mitigating, the risk and doing this in a really institutionalized way, to bring this to market in an easy, secure, and advantageous vehicle.
And we get
So
to,
if we jump to, go ahead, Connor.
I was saying, and we get to secure the Ethereum network in the process.
Yep, exactly. And that's a great point, which I mentioned earlier, is for investors and holders of Ether, securing the network better helps secure your investment, essentially. And so for us as an asset manager, when we thought about how to integrate staking into our product, we were very motivated to support the Ether network, to help secure the Ether network through staking, because ultimately it helps protect client assets by keeping the network even more secure, and it provides additional return, of course, for those investors. That said, making sure that we're mitigating risk associated with that, working with the best-in-class partners and managing the liquidity, and setting up infrastructure to be very robust, that is a key component as well. So balancing all of these components to bring what we view as the best-in-class product to market is crucial. So let's jump to the next slide, Connor. One more. So again, the product hasn't launched yet, but our two Ether vehicles, ETHQ and QETH, both of those, we are anticipating enabling staking in those vehicles in the next several weeks. That is all being done in partnership with Coinbase, who I mentioned, also Tetra. So Tetra and Coinbase are our custodian-sub-custodian relationship. And Coinbase is managing all of the staking infrastructure in hand in hand with us. I know I saw some questions in the Q&A around who our staking providers will be, and Coinbase is our staking provider for these vehicles, or will be when they are fully activated. And then again, they will be available through traditional brokerage account and TFSA, RSP eligible accounts, making it much more simple for tax reporting and ease of access. But we are in the final stages of working with the regulators to make that a possibility. I see a question in the chat around will some of the staking be handled through Tetra? So from a technical standpoint, no. Tetra is our custodian, and Coinbase is our sub-custodian. The actual staking of the Ether will be done through our sub-custodian at Coinbase. But Tetra and Coinbase work very closely together with us on everything from a custody perspective.
I don't mind answering an anonymous attendee said, Connor mentioned each validator could in theory offer a different APY. What factors determine the effective rate that they offer in practice? Well, programmatically, the more and more validators that are online on the network. So if we came online, for example, and deployed 100,000 ETH, let's say that, technically everybody else's consensus layer rewards on like a per epoch basis would be less, because it's inversely related. So the more validators that are on the network, the less of the pie slice that you get for every existing validator that's out there. But the real thing that's actually impacting APY is a combination of those consensus layer rewards that I was saying before, and another one called the execution layer rewards. Now, the execution layer rewards are the ones that are the most variable, and those are the ones that are going to impact the total APY if you thought of it over a yearly basis. And what can happen is say, I had mentioned in the earlier slide that there's an algorithm that can choose a validator to propose all the transactions in that block or broadcast those transactions. those blocks of transactions could have differing amounts of fees. I'll put this in layman's terms, but basically, if your validator proposes a block that has a ton of fees in it, you can make all of those execution layer rewards. So that could be a lot. So for example, if there's a very if the network is really active right now, and say there's like an NFT project that everybody's paying, you know, crazy amounts of gas for, or whatever it is, and the network's really busy. Well, validators during that time period, if you're selected, you can make a ton. Like there's been scenarios where in single, basically in single blocks, you can make like several ETH because of substantial transaction fees. There's also things like, I mean, I don't want to get too into the weeds, but maximum extractable value, like MEV, basically validators can pick and choose an MEV relay that can choose and organize the transactions the way that they want them. And basically it can just maximize the amount of execution layer rewards that you can get. So what that means is like I said, every validator is going to have like a differing APY. So even if you're on, you know, an exchange's platform, they might say that they offer 5% to stake, when in reality, the exchange itself might be making 5.5%, but they just give their clients 5%. So I think we have to take a step back and say the Ethereum network gives this much, but your service provider gives you this much. So you'll obviously have to look at the business case for that, because some of these service providers can take fees for services and stuff like that. So everything kind of comes out, but at a network level, every validator is technically different, because they can also be spun up at different times. You know, if we activate a validator yesterday and then we activate a validator next week, pending like there's no changes in fees or anything like that, technically the validator that started before will have a higher APY because it just has more time in the network that it's been staked, right? So there's a whole bunch of things that can come into that equation. And we thought about using some kind of, or thought about investigating some kind of index provider for like the annualized percentage rate for the whole network. But I find it's very difficult because every validator can be so wildly different. I mean, you could take a statistical mean or something like that, but for the case of our assignment, we're not really looking into it too much.
Less technically, if I could distill that down, you know, in my mind, it comes down to validator performance as well as the fees they charge. And that's why, you know, one, oversight is so important, because you have to compare how well you're doing compared to the market, you know, constantly. But it's also why diligence on validators is so important, because you have to, you know, see how they've historically done, you know, understand how they're technically doing this and how they compare, and also any risks that they come with. So I think it's a great question, but it's really, you know, very dependent on the validator and the fees they charge.
Yeah, and I see kind of as a follow-on question, someone asked, you know, how will you be able to see what the APY is for like a regulated fund like ETH, for example, the ETF? And so again, while I can't, maybe I should just say now that we'll likely host another webinar post the formal announcement in the next few weeks, where we could actually talk very specifically about the structure of the funds. But for now, I'll have to be a little more, a little less specific. But in general, for like the APY in the funds, on our website, we will likely be disclosing exactly how much ETH has been earned from a reward standpoint for the fund. And I do want to also highlight that it's likely, or it's our intention to reinvest those proceeds in Ether in the fund. So the funds are not going to be passing out yield, although that yield will be generated and add to the net asset value of the vehicle. There's some additional question, another question about what percentage of the ETH in the fund will be staked. And I again want to, I can't be super specific, but depending on the liquidity profile of any vehicle, any regulated vehicle, so different vehicles will have different liquidity requirements. So our closed-end fund, for example, QETH, has a monthly and an annual redemption, which is a lot different than an open-ended ETF like ETHQ, which is an ETF that has daily creations and redemptions. So essentially, that means that that one fund will be able to stake more Ether because there's less of a daily liquidity requirement than the ETF, which has daily liquidity requirements. So they'll have to be more conservative we'll have to be more conservative on how much ether is staked in one vehicle versus the other, and that will go for any type of regulated vehicle that you're dealing with. In the future, things like liquid staking, as they get more robust, or other creative solutions, could potentially be utilized to increase the amount of yield. And that's something that we're definitely going to be continuing to evaluate in the future, but that space is still relatively new. And so until it's a little more robust from a liquidity standpoint, that will be more on hold.
There's another one here from Mike M. Can you share a summary of the due diligence you did to arrive at staking through Coinbase versus holding Lido staked ETH, or any other options you looked at? Well, without getting too into the weeds on the exact product, I want to bring up regulation and how, under 81102 and investment funds in Canada, at least for digital asset funds, we need to use, and we brought this up before, segregated custody. Now, when we think about what a liquid staking token is, or at least most of them, in this case Lido, it's essentially omnibus style staking, right? It allows you to stake less than 32 ETH. Therefore, how do they meet the threshold to be a validator? Well, they pool client assets together to meet 32 ETH minimums. So how does that make sense from an investment fund manager, which must have segregated assets which cannot be encumbered? We need to use segregated custody. And that's why when we had chose Coinbase for this, they had given us the ability, or they have an offering that allows us to do segregated and dedicated validators. And that was a core contribution. I could send you a few more things, Mike, but that's a big one. And the big concern we have with liquid staking is the use of, pooling client assets together. We can't intermingle our fund's assets with a random participant in Korea or South Africa or America, whatever it may be. So keeping the assets segregated in cold storage was like one of the most important things for us. And unfortunately, Lido doesn't meet that for now.
In selecting our underlying partner, and as we mentioned, diligence is a huge piece of selecting any service provider here. And I think it was very multifaceted, but prioritized two areas of specific. One was technical diligence, and another was business diligence. On the technical side, we employed an independent third party to help us review down to the level of opening the hood and understanding how everything works and how we'll integrate with our systems currently. And from a business standpoint, that's everything from evaluating financials and reputation, knowing who we're doing business with. So I don't think we get too in the weeds on any of those things, but absolutely a high priority for us.
Yep. I've seen a few additional questions in the chat, all kind of related around, liquidity and percentage of assets staked. Again, I can't get into a ton of specific detail, but one of the big components that we as the fund manager and been working with the regulators is ensuring that the funds, of course, have the appropriate liquidity, which means limiting the amount of assets that we stake, making sure that we're holding a substantial reserve of liquid assets to ensure that we can meet daily, weekly, monthly redemption requirements. In addition to utilizing things like lines of credit to make sure that we can fund redemptions. Part of it, which was also mentioned in the question, is that dynamic unbonding queue, which the times can fluctuate. So we have real-time tracking of what those queues look like, and making sure that we are modifying and adjusting the amounts staked in our portfolios to adapt to those changing queues. At times in the past, the queues, the unbonding periods went very, very long, and then they've dropped down to much lower time periods, and that continues to fluctuate. I think we've reached kind of a steady state now that staking the Chapella upgrade is, I think, over 6 months now, or around 6 months since it's been live, and so there's a lot less volatility in those queues than there was before. But that said, that is a big part of why having a professional manager that's working with institutional partners to manage the liquidity of this, that's a key component, and another reason why we've spent a lot of time working with the regulators on making sure that we set the appropriate parameters, operational procedures in place to manage that liquidity. There was another question here in terms of granularity of rewards reporting. Again, we will likely update our website, which will have details around how much Ether rewards have been generated. But there will be more to come post-launch with what our dashboard looks like and some of the details that we'll be able to provide.
Also open to suggestions as well. Like if there's certain things, do you want to see it over a month-by-month basis? What it's like on the week? Do you want to just wait for the quarterly or yearly report to come out? We're pretty open to that. Like that's more of a marketing decision. Yeah, that would be it for that. There's how will the fund holders receive staking rewards? Will the value of each fund unit increase? Without getting too much in the weeds, what will happen is the staking rewards will be automatically baked into the net asset value of the fund, and therefore the net asset value per unit of the fund. So it increased the net assets. We don't plan to have distributions or dividends, so there's no tax implications. It'll just increase the value on a per unit basis.
Someone asked, how will the fund holders receive staking rewards? Will the value of each fund unit increase? And I think I touched on this earlier. We won't be distributing, we likely won't be distributing staking rewards directly to the holders. Instead, they'll be reinvested into the fund. So the net asset value of the fund will increase by the amount of the rewards. To your point, will the value of each fund unit increase? The answer is yes.
Will there be other cryptocurrency ETFs in the near future? I don't know if we have plans in the near future. I don't know if I can even say that.
Well, I'll say this. Canada's been at the forefront of this industry for a long time, and 3iQ's been on the forefront of that for a long time. So, if there will be, we'll be there. I'll say that.
Yeah, I agree. We continue to push the boundaries, as you can see here with the staking product and being the first to launch the first Bitcoin and Ether products in North America. We're always continuing to push the edge of innovation for what can and can't be done. Obviously, the last year, with a lot of the regulatory targeting to the crypto space, just on a global scale, has definitely set the space back and slowed down the comfort level for all different regulators around approving different types of regulated vehicles like ETFs. But I think the good news is through all of that, there's becoming more regulatory clarity as part of those different lawsuits. We've seen it with Ripple. We're seeing it now with some of the other lawsuits that are mentioning other crypto assets. If they're going to be treated as securities or commodities, or how they're looked at from a regulatory perspective, that level of clarity will help actually push forward on the ability to launch regulated ETPs with those other crypto assets, especially as liquidity comes back and the space starts to expand again. So I think to Andrew's point, we are constantly pushing for that innovation. It really is where we can find open-minded regulators and partners that we can make that happen with. So more to come on that in the future.
Very good.
I think that's all the questions I see in the chat. Oh, there's one other one here. Around is Canada preferential jurisdiction for staking? Andrew, maybe you want to jump in on this one, but I will say that the Canadian regulators have been really forward thinking on staking in general. They released staking guidance for crypto trading platforms, while other large jurisdictions like in the US at the same time, regulators were sending cease and desist letters to staking platforms. So kind of that juxtaposition has been really interesting to see. The regulators in Canada are really open-minded to staking and trying to put some clear guidelines, risk disclosures, rules of the road in place. And they've continued to do that, working with us and other asset managers in being able to enable actually regulated fund vehicles to bring staking to the market.
That's exactly what I would have said.
Great.
Okay. Well, I think we've gotten through all the questions.
Yep, and we're running right at time as well. So
Okay. All right. Well,
Perfect.
thank you all very much for joining. I hope that was insightful. Hope everybody learned something.
great.
Great.
And
Thank you everyone again. And feel free to reach out. Our contact information is here on the slide. And I mentioned earlier, but post the completion of us launching or enabling our Ether ETPs with staking, we'll likely host another webinar with some additional detail about the product structures that we'll be able to share. So look out for that in the next few weeks. Thanks everyone again.
Bye.